They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a billion-dollar mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. What's up, everybody? Welcome back to the DO Show. If this is your first time here, my name is Dustin Owen, aka DO. And this show exists for people who want to actually understand money, not just react to it. Because most people don't get into trouble financially because they're reckless. They get into trouble because nobody ever slowed down long enough to explain how this stuff actually works. Everything in finance feels urgent. Buy this now. Don't miss this. You're falling behind. And urgency creates bad decisions. So on this show, we slow down. We take a deep breath and we take a step back. So today, we're talking about insurance, disability insurance, life insurance, as well as whole life insurance. 3 topics that most people either avoid completely or misunderstand almost entirely. And I get why. Insurance is not sexy. It doesn't feel rewarding. You don't get a dopamine hit from buying a policy. But insurance is not about excitement. It's about control. It's about making sure that one unexpected moment doesn't erase decades of hard work. We're going to run today's episode using what I call the 3-2-1 format. And I want you to know that up front so you can track where we're going. First, I'm going to answer 3 real questions from the audience. These are questions people are already asking but rarely get straight answers to. Then we're going to walk through 2 very specific recent news stories that show how insurance decisions are impacting real people right now. And finally, I'm going to spend serious time on one topic that creates more confusion and regret than almost anything else in personal finance, and that's whole life insurance. This episode is not about telling you what to buy. It's about teaching you how to think. So let's get started. I'm Dustin Owen, and this is the DO Show. 3 questions from the audience. First question, what do you think about using crypto to save for retirement? So let's start with this question. It's this question that tells me something important. It tells me people are searching for certainty in a world that feels increasingly unstable. Crypto feels modern. Crypto feels cool. It's detached from traditional systems. It feels like control, and I definitely understand the appeal. But the mistake happens when people confuse potential upside with retirement suitability. Retirement money has one job, not 10 jobs. And its one job is not exciting. Its job is to be there when you need it. Not when it's trending, not when it's getting headlines, not when you actually need to live on it. Crypto is volatile by design, and that volatility is what creates opportunity, but it's also what creates risk. And risk behaves very differently at different stages in life. When you're 25, volatility is definitely tolerable. You have time, you can recover. When you're 65, or heck, when you're 55, volatility becomes dangerous. Here's something most people don't think about. The order of returns matters more than average returns, especially when you're near retirement. If markets drop early in retirement and you're pulling income at the same time, you may never actually recover, even if the market rebounds later. Now layer crypto volatility on top of that, and you'll see entire portfolios disappear. Liquidity dries up, sentiment shifts. That's not just volatility, that's uncertainty. This is why regulators and lawmakers have been hesitant to allow crypto inside mainstream retirement vehicles. Retirement assets carry fiduciary responsibility. You're not supposed to gamble with money people need to live on. So my position, it's not so much anti-crypto, but it's definitely anti-confusion. Crypto can be a part of a portfolio, but it needs to be a small part, a very speculative part, a part you are emotionally and financially prepared to lose. But your retirement plan should be built on boring things that work. Boring is beautiful when it comes to not outliving your money. All right, here's our second question. This question actually came in from Brian in Sacramento, California. Brian asked, would you do term life insurance or whole life insurance? Wow. Well, Brian, this question deserves more time than it usually gets. Life insurance exists to replace income, period. It's like if you die tomorrow, what financial hole does that leave? That's the only question life insurance answers. Term life insurance does that job efficiently. It gives you a large death benefit for a very low cost during the years that your income matters most. Those years are predictable. When you're working, when you have dependents, when you have debt, when your family relies on your paycheck, that's when term life insurance shines the brightest. Whole life insurance is fundamentally different. It's permanent, it builds cash value, and it blends insurance with savings. That bleeding is where people get confused. Because when insurance starts pretending to be an investment, expectations get misaligned. Whole life insurance is not designed to outperform markets. It is designed to provide guarantees. Guarantees cost money. So if someone shows you whole life projections next to stock market returns and frames it as a replacement, well, in my experience, that's a red flag. The real question is not which one is better. The real question is, what job do you need done? If your goal is income replacement, then term is typically what wins. If your goal is permanent coverage with long-term planning considerations, whole life might belong in the conversation. There are different tools and they do different jobs. So let's go to question number 3. Question number 3 comes from Maria in Queens, New York. Maria asks, what are your thoughts on disability insurance? Phenomenal question, Maria. This is a topic I love to cover. It's the most important question probably in the entire episode. You see, your ability to earn income is your greatest financial asset. It's not your house. It's not your retirement accounts. It's not even your investments. It's your income. And as they say, if the income stops, everything else starts to wobble. Disability insurance protects your paycheck if you can't work due to illness or injury. And here's the uncomfortable truth. Most disabilities are not dramatic accidents. They're cancer, they're autoimmune disease, they're mental health conditions, they're back injuries, they're chronic illnesses. Things that don't look catastrophic but absolutely stop you from working. I once knew a girl whose dad couldn't work because he had crazy bouts with dizziness. Like literally couldn't get out of bed because he was so dizzy. When all this happens, savings disappear fast, especially when medical expenses show up at the same time. Disability insurance buys time, and time is the most valuable thing when life doesn't cooperate. If you earn a paycheck, this should be foundational. Now, it's good to know most employers provide some form of long-term disability. And quite honestly, if you're fiscally responsible and you have 3 months reserve, you probably don't need short-term disability. But what you do need is long-term disability. That's a disability policy that picks up starting day 91. So for example, if you're anything like that girl's dad and you get crazy vertigo and you can't go to work, well, those first 90 days, if you're not covered, you should be fine. Why is that? Well, because you have at least 3 months of reserves sitting in some kind of a liquid savings account. But then come day 91, if you're still unable to go to work because the room is spinning like a top, then your long-term disability policy would kick in. And although it might not replace the entirety of your income, it'll still replace a large enough portion to allow you to make sure your financial world doesn't wobble and to make sure that you can continue paying your bills on time until you can get healthy again to re-enter the workplace. So remember, if you earn a paycheck, long-term disability should be foundational in any type of wealth planning that you do. So this brings us to segment 2. Segment 2 is when I'm going to introduce you to 2 separate news articles that are relevant to today's topic. Our first topic comes from NerdWallet. Is whole life insurance a good investment in 2026? That's how their article was titled. This article matters because it actually slows down the conversation. The key takeaway is not that whole life is good or bad, it's that whole life is misunderstood. The article walks through guaranteed death benefits, cash value growth, and dividends, but it also explains high premiums, long break-even periods, and limited early liquidity. Why does this matter? Because regret doesn't come from bad products. It comes from mismatched expectations. People buy whole life thinking they're buying an investment. Then they're frustrated when it behaves like insurance. Whole life behaves exactly how it was designed to behave. Slow, predictable, and conservative. When you understand that, it becomes a tool. When you don't, it becomes regret. Now, story two comes from Be Insure, and it was titled U.S. Workplace Life and Disability Insurance Premiums Rebound. This article highlights that employer-provided life and disability insurance premiums rebounded in 2025. That sounds positive, but here's the catch. Most employer coverage is limited. It's capped and it's tied to your job. If you leave that job, well, there goes your coverage. This article reinforced something that I say constantly. If you don't own your coverage, you don't control it. Work benefits are a supplement, they're not a strategy. And then finally, segment number 3, which is one hot take from me. And I'm gonna get down with whole life insurance. All right, so let's get at it. Let's slow this down because whole life insurance is one of those topics where people either think it's the greatest financial product ever or they think it's a complete scam. And literally, you can go talk to 10 financial advisors. 5 of them will tell you how much they love whole life insurance. 5 of them will tell you, go with term and reinvest the difference. But let's break that down in a little bit more plain English that you'll understand. So here's the truth. Like most things in money, whole life insurance lives somewhere in the middle. So before I give you my opinion, I want to reset the conversation. Whole life insurance is not an investment that happens to have insurance attached. It is insurance that happens to have a savings component attached. That distinction matters more than people actually realize. Whole life insurance is permanent coverage. That means as long as you pay the premiums, it lasts your entire life. There is no expiration date. There is no term ends at 65 like you would see in a term insurance policy. It is designed to be there when you die, whether that's tomorrow or 50 years from now. It also has fixed premiums. What you pay today is what you pay 10 years from now, 20 years from now, 30 years from now, etc. That predictability is intentional. And then there's the part everyone focuses on, the cash value. Yes, whole life policies build cash value over time. That cash value grows as a guaranteed rate, and in some policies can receive dividends depending on how the insurance company performs. Those are the facts, not opinions. Literally just facts. Now let's talk about the part that gets glossed over, the trade-offs. Whole life insurance has trade-offs, and those trade-offs are not hidden. They're just rarely explained clearly. The first trade-off is the cost. Y'all, it's freaking expensive. Whole life insurance is expensive relative to term life insurance. There is no way around that. You are paying for permanent coverage plus a savings component. That costs money. If someone shows you a whole life policy that costs 5, 6, 7, or even 10 times more than a term policy for the same exact death benefit, that doesn't mean that it's a ripoff. It means you're buying a fundamentally different product. But if you don't understand why it costs more, you probably shouldn't buy it. The second trade-off is liquidity. Whole life insurance is not liquid in the early years. Let me say that again, because this is where most of the frustration comes from. Whole life insurance is not liquid in the early years. If you put money into a whole life policy, then decide 2 or 3 years later you want to back out, you're probably going to be disappointed. The early years are front-loaded with cost. That's how insurance works. So if someone tells you whole life is a great short-term savings vehicle, that is flat out wrong. You should literally turn your back and walk away. It is a long-term, by design, insurance product. The third trade-off is growth. Whole life insurance is not designed to compete with the market. It is designed to provide certainty. Markets are volatile. Whole life, pretty stable. Markets go up and down. Whole life moves slowly and predictably. That's not a flaw, that's on purpose. Now let's talk about where whole life can make sense. Whole life insurance can make sense in estate planning. This always leads me to state whole life is for rich people. Now that's not always the case, but it's a great way to think about it. If you have assets that are illiquid, like real estate or a business, and you want to make sure your heirs have cash available to cover taxes or equalize inheritances, whole life can be a tool. It can make sense for high earners. If you are making a lot of money, you're already maxing out your 401k. You're probably already maxing out your IRA and potentially even have figured out how to do a backdoor Roth conversion because you make too much money to qualify for a traditional Roth IRA. And now you're looking for another place to put even more money? A place where taxes are managed and certainty matters more than upside? Then look, whole life might belong in that conversation. It can make sense for people who want guaranteed legacy dollars. Some people care less about maximizing returns and more about knowing with certainty that a specific amount of money will be there for their family when they need it. Whole life does that extremely well. And it can make sense for people who understand long-term commitments. If you understand that this is not money you're touching in a year or 3 or 5, and you're comfortable with that, whole life becomes much easier to evaluate. Now let's talk about where whole life does not make sense. Whole life does not make sense as a primary retirement strategy. If someone is telling you to replace your 401k, your IRA, or your market investments with whole life insurance, that should give you pause. Whole life is not built to accumulate retirement income the way traditional retirement vehicles are. It plays a different role. Whole life does not make sense as a replacement for term life insurance. If your primary goal is income replacement while your kids are young and your mortgage is large, term life is usually the more efficient solution. And whole life absolutely does not make sense if you do not understand why you are buying it. Let me be very clear about this. Whole life insurance is not evil. It's also not a scam. It's not a miracle, but it is a specific tool. And specific tools are incredibly useful in the right situation and incredibly frustrating in the wrong one. Most regret around whole life insurance does not come from the product itself. It comes from mismatched expectations. People think they're buying an investment and they're actually buying insurance. People think they're buying liquidity and they're buying commitment. People think they're buying growth and they're buying certainty. When you understand what whole life is designed to do, you can decide if it belongs in your plan. And if it doesn't, that's okay. Good financial planning is not about owning every product. It's about owning the right products for the right reasons. That's the DO take on whole life insurance. And if I had a couple more things I wanted to add as it pertains to whole life insurance in general, it would be this. Before you have children, before you own a home, most times life insurance isn't overly necessary. All right, let's find a way to put a nice little bow around today's episode. If there's one thing I want you to walk away from, it's this. Insurance is not about pessimism. It's about preparation. Nobody buys insurance because they're expecting something bad to happen. You buy insurance because you understand that life is unpredictable and you don't want unpredictability to destroy the people you care about. And that's it. It's about the people you care about. This entire episode was really about control. Control over your income, but control over your family's future. Control over what happens when life doesn't cooperate. We talked about crypto and retirement because too many people are trying to solve long-term problems with short-term thinking. Retirement money needs stability more than excitement. We talked about term life versus whole life because protection and investing get confused all the time. And when those lines get blurred, people overpay, underprotect, or sometimes both. And we talked a lot and spent a lot of time on disability insurance because your ability to earn an income is the engine that drives everything else in your financial life. If that engine stops, the rest of the plan doesn't matter. And here's the reality. Most financial damage doesn't come from one massive mistake. It comes from one blind spot. A blind spot where income isn't protected. A blind spot where coverage is assumed but not understood. A blind spot where people think, well, that won't happen to me. Well, until it does. And look, I don't say that to scare you. I say it to empower you. Because once you understand how these pieces work, you can make calm, confident decisions instead of reactive ones. You don't need every product. You don't need perfect timing. You don't need to chase every trend. You need a solid foundation. And a solid foundation starts with protecting what already works in your life. If this episode helped you slow down, think more clearly, and see these decisions differently, then it did exactly what it was supposed to do. I get it. The topic isn't always sexy. But you know what? Becoming wealthy isn't a sexy process. Now, if you want more conversations like this, real talk, real education, no hype, no gimmicks, make sure you subscribe to this channel. You can watch more episodes of The DO Show right here on T-Lop Entertainment. I'm Dustin Owen. That's all the time I have for you today, but I do look forward to seeing you on the next episode. Peace.